Good Thursday afternoon to everybody out there. Thanks for tuning in to Freight Forecasting. I'm Michael Vincent, Freight Forecaster here at FreightWaves. And today we're going to be talking about the futures of freight. And I've got two special guests, two good friends of mine, two very knowledgeable people. First, I've got Daniel Stanton, Mr. Supply Chain. Welcome to the show, Daniel. How are you today?
Doing great, Mike. Thanks so much for having me on. Love to have the opportunity to hang out with the dude.
With the dude. And we've got another guest as well, Kyle Lintner, who is Principal and Managing Director at K-Ratio. Kyle, how are you today?
I'm doing well, Mike. How about you?
I'm doing excellent, my friend. Thank you so much. And as you said, no fireworks today, and I did not drive my DeLorean in today either. The flux capacitor is down, so it is in the shop.
Oh man, they're already on the date with the obscure movie references.
All right, we're done. We're done with those. We've done the dude. We've done the dude. We've done the DeLorean, the flux capacitor. So let's move on to the issue that is at hand right now. I've got sonar. I'm going to be showing some screens here, and we're going to blow through a lot of these pretty quickly to really get to the end game here, but really setting the stage as to what is going on right now. Right, we had unemployment numbers that came out today. They come out weekly, or the jobless claims, I should say, initial and sustained, and both of them showed numbers that have been coming down. And I've got the unemployment rates that are pulled up here. If we could show that on the screen here real quick, and so the guests can see them as well. When we talk about claims coming down, initial claims and continuing claims, and we think it's a good trend, here's the reality of it, right? A good weekly initial jobless claims is not 1.3 million, right?
It's all relative.
I mean, that's not good. It's good that it's coming down, but that's not good. And when you're talking about here's your unemployment rate, and there's your unemployment rate back to 2015 of where we're at right now. When we look at continued claims over here on the far right-hand side, okay, so we're over here at about 18 million, I think is what it came out today was. But still, we should be well below 2 million, right? Isn't that right, gentlemen?
Yeah, and to me, that one on the end, the continued claims, that's the worrisome one. That's the one that shows people are continually out of the workforce at a prolonged period of time. And that's when you start to have the questions about what this is doing for the overall economy. If we think that people aren't, not only they're not working, but that's how much less money that comes out of the economy, considering that the U.S. consumer is the primary driver. And it seems like lately the only driver of the U.S. economy.
Yeah, I'm with that. I mean, I think, the key is there's a huge difference from, listen, we're all going to take, a month or two off, and that's going to be, right? It's going to be PTO, it's going to be some, from, oh crap, that job went away, and now, we just don't have jobs for people. And that, to me, is what the chart is doing, is rebalancing, right? So nobody was surprised that there was a huge spike in jobless claims when we knew we were going to shut things down for a month or two. The really concerning part is, okay, what does it look like when we get back to steady state?
Yeah, exactly. Yeah. What does it look like that? And we're not even at steady state right now. We're talking about we have states that are starting to go back into a little bit of a lockdown, and there could be closures and so on and so forth of the different businesses throughout those different communities, and that could cause those initials to go back up, right? And as you said, the initials coming down means there's less and less more people every week. But it's the continuous that's really concerning. We don't have a whole lot. We got like 25 minutes and a ton of stuff. So next slide here, or the next chart that I have up here is maritime imports, and this looks pretty decent on the left-hand side. You got your monthly uptick in imports of distribution services, manufacturing, retail. Of course, is skyrocketing, but durable goods and non-durable goods, etc., are all coming up. Although you look at this chart that I have on the right-hand side, and you're looking at the trends, we saw the initial spike, and now we see this kind of W effect going on, and we're at the bottom of this next trough, and I've got the a moving average on here. That doesn't necessarily look good. And by the way, this monthly, if we change that to weekly, it's not so good, week over week. 2 weeks is not so good. And so that's near term. But, okay, let's look at this. Yikes.
Right.
There's your yearly. Daniel, thoughts?
Well, so when we first hit this, way back in probably March, when we started like running out of toilet paper and stuff, my thinking ended up focusing on sort of 4 different problems, right? Because supply chains are about balancing supply and demand. And so we had 3 kinds of disruptions on the demand side that we were dealing with all at the same time that were creating bullwhips. And then we had to start thinking about the supply problem. So, people were rushing out to stock up on toilet paper without, if that ends up being 100, 200, 400% increase in demand, the supply chain just can't keep up with that sort of a spike over a short term, right? So that drained all the inventory and we just had to replenish. It seems like most of that has worked its way through the system. There were some other things where demand just dried up, right? Anything having to do with sporting goods or sporting events or entertainment. And so that stuff just came to a shrieking halt. But again, I think to a large extent, those things are sort of stabilizing. And then there was a category of things where we need more of them. Lysol wipes. And even today, we can't get those reliably everywhere we want them because demand has genuinely increased. But the thing that I was really concerned about in March, and I think we're starting to see now, is disruptions on the supply side, right? Where, if you think about on the durable goods side, anything that you're going to manufacture, from a car to a washing machine, there are thousands of parts that go into those that probably come from, at least 100 different suppliers to any one factory. And, for those parts that come from all over the world, if one of those parts from one of those factories isn't available, well, it can screw up the whole supply chain, right? It can shut down the factory, inventories build up. And that is an effect that takes a couple of months to see. So anecdotally, my wife is a realtor. She closed on a house for a couple yesterday. They had gone to local hardware store to buy a new washer and dryer for the house that, maybe October before the washer and dryer.
Wow.
Right. And so there's a quote that I love that I stole from my friend Jason Schenker, who is an economist. He said, the plural of anecdote is data. Right. So I've got one anecdote, but it confirms my theory. And I have a feeling that's what we're going to be seeing in the next few weeks is even if consumers wanted to buy stuff, even the folks that are in a position to buy it, if you don't have supply, you can't sell it.
Excellent. Yeah, excellent points. Kyle, you have thoughts on that?
I agree with everything Daniel said. It's the truth. And the only thing I would add to that is it does create an interesting setup moving forward that when this stuff does come ready and does come online, the demand is so high and so firm for it that it's going to be one of those express situations. This stuff's going to go OTR. It's going to go long haul. No one's going to care about putting it on rails or waiting. This stuff's got to get there fast because these people are waiting on it. So from just a freight standpoint, that puts a tremendous amount of pressure on available capacity. And now we'll get those situations where pockets of markets will have extreme spikes in rates.
Yeah, absolutely. And I've just put up a rail chart here, and I hope it some of these I've got to adjust because I've got 3 charts on the same thing. But this looks good if we can show these for everybody. Your point of that express service is kind of what we're seeing right now. Southern California has been just on fire with outbound tender volumes and then rejections. It's softened a little bit. It's 4th of July week. We'll see what happens after this week. But you're seeing that blow up. While meantime, total carloads in the United States, and I could pull up the LA lanes out to Dallas, Chicago, et cetera, and show the exact same thing. But they're down. I mean, railcar carload is the only thing really showing any real signs of life. Chemicals, et cetera, which is production, going to give you a good indication of production, has come back up. But, I mean, it's from a huge high where it had just not rebounded, right? I mean, this is the normal is way up here, not down here in the 31,000 range, 31,500 range, and here's total carloads. So, I mean, that speaks to it right there, does it not?
It does, and this touches on a little bit of some other things that you and I have discussed recently, and that's this is starting to get into that industrial area when we're talking about chemical carloads. not so much finished goods for a consumer. And there's obviously a lot of debate right now about the health of the economy. We don't have the manufacturing quite like we'd want. But as far as retail goods, that volume of freight is through the roof. So this becomes a scenario where it's almost like we've lost automotive, we've lost industrial production, we've lost some heavy manufacturing. But from a consumer standpoint, and that's the majority of the freight that moves. We're talking about dry van way more than anything as far as reefer or flatbed is concerned. And from that standpoint, we're doing tremendously well. It's almost hard to believe, and you've seen these numbers recently on the volume metrics. We're so far beyond anything that we've seen in just the 3 years that this has come out. Anything beyond 19 for sure, and 18, which is astounding.
Yeah, absolutely. As I said before, we got to keep the pace going on. Excellent point. So, Kyle, first off, I've got this. You can see it all right there. Yeah. Yeah, I've got another chart back up here now. If we could show this to the audience and the guests as well. What I have up is the ISM Fed and the LMI numbers. And so let's speak to this a little bit. Some of these look pretty decent, right? You show these Chicago Fed activity numbers, and they're all green. And they're right here in this middle left-hand side. Some of them setting 52-week highs, New York, etc. You got these. You've got the composite index in LMI, which is setting a 52-week high. And inventory levels are coming close, reaching their 52-week high. Does this mean we're in great shape, Kyle?
I wouldn't say great, but this is what you would want to see. So this is what everyone was hoping for when we went into that lockdown. All right, when we come out of it, we need to see all of that pent-up demand, and we need to see what wasn't being produced start to get produced. And I think that's what we're seeing here. You're seeing anything on any of these metrics being that backlog or the back orders being fulfilled now. And the hope is that this continues to move forward. And I'll say that if it does, and we keep any sort of the pace that we have on the retail side of it, the second half of 2020, it's going to become a total nightmare as far as rates and securing capacity is concerned.
Yeah, very possible. Daniel, your thoughts on this?
Yeah, so the thing that I get scared about is just like we always predict that the future is going to look like the present, right? And so if things are trending in a certain way today, we kind of project that out for the back half of the year, and we say, okay, just like Kyle was saying, we're really going to be strained for warehouse capacity. We're going to be, it's going to put pressure on rates for trucking. But what happens, very often in supply chain is we have these bullwhips, right? So it goes up really, really fast like a roller coaster, and then all of a sudden it pivots and it starts heading down. Well, everybody's positioned to continue the ride up, right? And so then that fall down actually gets amplified. So the truth is, none of us know for sure. We're looking at the data about what's happening today and what's happened over the last couple of weeks and months, but so much can happen, in the months ahead that can change that so quickly, right? And so if this is really the challenge, is do you position yourself so that you're really prepared for what's happening now to continue happening? Or do you position yourself so that you can be flexible enough to adjust? And how do you tell when things are changing, when we hit those inflection points?
Yeah, exactly. Well, let me clear it up for you. I've got a chart that another chart that I've pulled up here. It's two of them, and these are going to make it very clear for you. And then I'm going to ask you a very simple question after we kind of look at these real quick to each of you, and I'm sure you're going to be able to just spout the answer out right away. So if we could bring these up for the guests here, here's a test for you guys and everybody else out there. So on the right-hand side here, here's the outbound tender volumes, and it's seasonal. 18 is in orange, okay? 2019 is in green. This blue here, here's the run up to, this is this year, here's the run up to and right up to 4th of July, and here's this week. And what we're seeing here is you normally see this trough flatten a little bit here in 2019 and come back up. This continues to go. There's no flat. It's starting to flatten here, but remember, we're 2 days ahead of here because of the change in calendars every year. Does this come back and go? But here's the volumes, and you can see it acted fairly seasonally here, except for this large spike right here. And now this is what happened the rest of the year. Over here on the left-hand side is outbound tender rejects. Now you've got 2019 in green, 2018 in orange, and this is this year. The interesting thing here that's going to help clarify this a little bit for you guys is here's your outbound tender rejects in 2018 on 11/6, and here is your outbound tender rejects in 2019 on 11/6. If we move this out, we see that there was almost no difference in volume there. So outbound tender rejects start to put pressure on the spot market, and then truckload rates, et cetera, and can lead those rates. So given this information, what's the national van average rate in October this year? Where are rates going to go? Like, what are they going to look like in October? Daniel, you got an answer for me?
Oh, man, not a chance, Michael. So I'll tell you, as you were going through that, the volume chart here looks more useful from my perspective than the reject index. Because the thing that I'm seeing from that chart coming off of 4th of July, in the next 2 weeks, that's when we want to look for that bump as an indication of what's really going to happen in the back half of the year. Right?
Yeah.
So,
how does this occur this year?
Exactly. If it does or if it doesn't. And do me a favor, set an alert and send me a message when we get there, and let me know what you're seeing on the index, because I want to know.
Well, Daniel, if you had sonar, you could set an alert yourself right up here in the toolbox.
Oh, I know.
Right here. And it would before you even got out of bed and made your coffee, it would tell you the back half is on, bro. Rates are going up.
Right? Get ready for it. But I would refer to Kyle. I wanted to jump in with the easy stuff first so that Kyle can stick his neck out and actually.
Oh, I appreciate that. Thank you, Daniel. No, I'll say this here. I don't have a crystal ball. I don't know what that rate's going to be. If I did know what the rates were going to be in the future, I'll be honest, I would not be on the phone with either one of you right now. I would be on my own island in the Caribbean. But all I ever do for clients is the same thing. You present all of the scenarios and tell them with some probability what's likely and what's not. And here are your potential setups. And this is your defense mechanisms for what you can do around it. And what I'll say about rates right now, and if you want to be specific and say something like October, right now we do have current conditions that could give us an October beyond what we saw in 2018 during the tariff pull forward. So if we think back to that time, 2018 obviously was a tremendous year for rates. There wasn't enough capacity. We all know the story. We're coming off of the new mandate as far as hours of service. As the second half came around and things began to calm down, outbound LA just took over. But then that quickly became the only market in town. So now if we try and look back to that, it doesn't make as much sense, but there's a little bit we can pull from that. And what I mean is, for whatever reason, we don't have the answers, but outbound LA right now is driving the entire market. And when you have something like that, and especially long hauls, like we were saying earlier, this stuff's got to get there and it's got to get there fast. So people are just taking it from LA to whatever the final destination point is. That creates further disruptions around the supply chain, because now it takes maybe 2 or 3 loads for that truck to get back to where it wanted to be, because he went from LA all the way to Atlanta or LA all the way to Chicago. So that creates a compounding or a snowball-like effect with capacity not being in the right place at the right time. And when you have a market like LA that is overwhelmingly larger than anything else, it can dictate rates for the entire country, even if the other markets are soft, because carriers will do whatever it takes to get out to LA, knowing that they're going to get not only high rates, but long miles at high rates. So we don't necessarily have to see other markets with a tremendous amount of volume. We just need to have something that disrupts it. And I think for 2020, all bets are off. We don't know what we should see moving forward from this, because we've never experienced anything like this. Nobody's ever gone through a global pandemic with the current supply chain. So there's no playbook to look back on and say, okay, this is what we can reasonably expect.
Yeah, I've never been through an economic restart. Have you, Daniel?
No. And I was going to jump in on something Kyle was saying. So we were looking at the volume chart, right, and saying, volume of truckload is largely driven by consumer consumption. And in the next couple of weeks, we hope to see that kind of jump back up after the 4th of July holiday. But that's all on the demand side, right? That's not talking about capacity. We had the news in the last couple of days about YRC getting this huge bailout from the government. That, for me, is a canary in the coal mine sort of situation, right? So the government's bailing out YRC, but there are a lot of folks out there taking on PPP loans and doing other things that are short-term fixes to big hits to the balance sheet and the income statement. And even if rates are okay, there may just be some structural financial things for companies, transportation companies, that it makes it harder to survive, especially for the little guys. Well, what does that do? It takes capacity out of the market, right? And so, regardless of what's happening on the volume side, if we're losing capacity because trucking companies are going bankrupt, that could be a huge disruptor to rates as well.
Absolutely. I agree with you. Looking at all the numbers, I don't suspect that the numbers of freight volume are going to stay that elevated like we saw pre-4th. They're going to come down, but I don't expect outbound tender rejections or the strain on capacity to reduce either. I've got a new chart here. We've got about 8.5 minutes left, guys. Here is the fireworks. Here's your rates, and I just picked Atlanta to Philadelphia, and in blue are your long haul rates, are your dry van rates. The green is the outbound tender rejects, and you can see how the capacity, strain on capacity absolutely influences those prices and goes forward. So we've all agreed that we know exactly what's going to happen with capacity and demand and capacity and supply and volumes moving forward. Obviously, we have no clue what's happening in 3 months. We've got things that are going under lockdown and opening up and so on and so forth. So, Kyle, how do I manage this out 3 months? How do I manage this? How do I look forward and say this is how I project my bottom line to look, my EBITDA, my costs line, my transportation costs?
Sure. The very easy, simple way to do it is to hedge. You use freight futures. We were talking about this prior to going on the air. I say this to clients all the time. These are the rates that are shown by the market, and if this is a rate that you are comfortable with and your business runs profitably at, proceed. And then you don't have any of these concerns. Now the unknowns are gone. Doesn't matter if the rates go higher or lower. You're fixed, whether that's from a revenue or an expense standpoint. You've got a healthy bottom line now with no volatility associated with it.
Absolutely. Daniel, your thoughts?
Yeah, again, this was a conversation we were having before the show. We talk a lot in supply chain about the value of data and analytics and some of the amazing things we're able to do these days with artificial intelligence, for example, right? But then, I think the work that you guys are doing at FreightWaves and with Sonar is a great example of how just in the last couple of years, folks that work in the supply chain can get access to stuff and analyze stuff in a way that wasn't possible. When I'll just say the three of us started off in the business. But when even with all of that data, what you realize is you're trying to sharpen up the focus in your crystal ball, right? And you can only sharpen that focus so much before you realize there's uncertainty in the world. There's entropy. There's stuff that we just can't predict. How do we manage that uncertainty, right?
Yeah, it's exactly right.
Where contracts and the freight futures come into play. And that's an instrument that's only been around for a year or so. So I think, for folks that work in supply chain and especially on the transportation side, both for shippers and carriers, this is a new capability that exists that people need to understand and figure out how to leverage so that, to Kyle's point, right? So that, you can stay profitably in business in spite of the fact that you don't have perfect information about the future.
Yep, yeah. That's exactly it. That's what I say all the time. And this isn't something about making money or having some sort of gains from the market. This is just about avoiding losses.
Yeah, absolutely, and I would echo that. I mean, the data that we have and we present via Sonar is incredibly useful for tactical and for short-term trends. It can be extended out further and further, but when you're talking about as disruptive a year as this is, and it happens every year, there's something that happens that changes these things. That hedging ability, it needs to be there because, like you said, even in a perfect year, your focus 6 months, months or 6 months, 3 months out isn't as good as it is, for today and tomorrow and for next week. Much unlike the changes in my eyes, it was the closer that went. Daniel, I don't know if you've experienced that, but so I've brought up another.
Mike, that'll never happen either. I just want to say that everybody, all these data points are amazing. I love them. I'm a huge fan of Sonar, and the more educated we become with data, the better we're always going to get.
Yeah.
But there are people out there that think we're going to reach some point where we have all of the answers and all of the solutions presented to us, and volatility will now be erased. And that simply isn't possible. And I say that because as the world gets more connected and as we all entangle ourselves further with each other, we're now increasing the variables inside of the supply chain. And when you have greater variability, you have greater unpredictability. So it doesn't even matter. The common question is always, well, what's going to happen when we get autonomous trucks? Yeah, that's going to help, but those trucks still aren't going to be in the right place at the right time when they're needed. And that's how we get imbalances in markets. And then, like we were talking earlier with LA, that creates a national problem. So to think that things are just going to get better by improving your data or your efficiency, it will, but it's not going to save the day.
It certainly is, and it's not going to change this volatility that's moving forward. So I've moved up. We've only got about 3.5 minutes here. So I've put up the chart of forward futures price, Kyle, and I was hoping you'd kind of talk to this and maybe explain a little bit about these freight futures that we talk so mysteriously about. How do they work?
Sure. So you've got Atlanta to Philadelphia here, and the blue is the current forward curve, and all that means is that is the rate for a period of time out into the future. And for here, we've got 7 or 8 months or so, and that's the rate you can lock in for Atlanta to Philadelphia within that month. Beyond that, you've got the other months up here. You've got a 30-day look back in green, the 60-day in orange, and a 90-day in purple. And those show you the historical performance of what we're looking at. So now this becomes something beyond just locking and hedging. This is where you can get into the analysis of it, and you can see how a lane has been performing over time. And the key takeaways for something like this is you can see how the market responded when the bottom fell out in freight. And it looked like we weren't going to move anything anymore because the lockdown wasn't going to end. And then you see the tremendous rebound in things to where we are now. We're still not where we were prior, and that's the 90-day all the way up top, but we're moving in the right direction. And then to take it a step further, this is what we were saying earlier. This is now something where if you're a shipper and you're starting to pull your hair out and say, I'm getting way too many loads going to spot. I'm paying out the you-know-what for this stuff. What can I do for it? Well, you look at the future, and it shows you what that rate is. And you say, yeah, I gladly would take that rate to run my business at. If I'll ship my loads at $1.60. And then on the other side of it, people always ask, well, why would somebody take the other side if it's going to go higher? And you're going to have a carrier that says, yeah, I'll take $1.60 to run my trucks. Maybe it's a backhaul, maybe it's a head haul. It doesn't matter. They just want to lock that rate in. So now you have two parties that are comfortable with the rate. They just want us to stabilize their expenses on one side. The other party wants to stabilize the rev. And both parties walk away happy. It doesn't matter if rates go higher or rates go lower. They're both getting what they knew from the beginning. And that ends up translating directly to the bottom line on the balance sheet. Not only are the volatility reduced with that, but you've got the fixed price from whichever side of the equation you want to look at it.
Daniel, what's your thoughts on that? And we've talked about this before as far as indexing contract rates to the daily assessed price on these futures contracts. Can you speak to that? Just we got about 30 seconds.
Yeah, at the end of the day, you can only eliminate so much uncertainty through analytics, and doing the analysis costs money, right? And so you reach a point of diminishing returns where you say, do I focus on trying to get a better prediction, or do I just lock in a rate so that whatever happens, I can still manage my business profitably? And there is that tipping point. But at the end of the day, I think the challenge for most companies is just understanding how futures work and how it plays into their supply chain. And then making that decision becomes, just part of a business rule.
Yeah, excellent. Thank you so much. We got about 10 seconds left. Kyle, how do people reach out to you and learn about K-Ratio and what you're doing there?
Easiest way would be the website, k-ratio.com, and that's where you go when you're one of these shippers, carriers, or 3PLs, and you don't know how to use futures.
Excellent.
We make it easy for you.
Right on. And Daniel Stanton, Mr. Supply Chain on LinkedIn. You can grab him all over the place. Guys, thank you so much for being on the show today. Really appreciate it. We'll do this again real soon and maybe break down these futures in even more simpler terms and get a little bit more complicated eventually going through these futures. I really appreciate it. Thank you so much. Everybody tuning in, thanks for tuning in. Until next week, peace and love.